Hey everyone, welcome back to Corporate Decoder, where we turn financial jargon into plain English. And if you thought last quarter was interesting, wait till you see what Ralliant Corporation has been up to in the world of splits and new debt. We're diving into Ralliant's latest filing, a quarterly report that drops some major financial news, especially around their recent separation and new financing. Let's kick things off by looking at their balance sheet. As of June 27, 2025, Ralliant has total assets of roughly $5.8 billion. That's a pretty significant number and shows the scale of the business they're operating. It's important to note that as of December 31, 2024, they had about $4.72 billion in assets, so an increase primarily driven by how they're structured after their separation from Fortive. Now, for some of the heavy lifting in how they're financing things, take a look at this line item long-term debt. As of June 27, 2025, it stands at a whopping $1.15 billion. Now compare that to December 31, 2024, when they had zero long-term debt. This massive jump clearly signals a big shift in their financing strategy, likely tied to their spin-off. And look at this for context, the net parent investment has also seen a big change. It dropped from $4.25 billion at the end of 2024 to about $3.28 billion by June 27, 2025. This is a direct reflection of the separation and how the company's equity structure has fundamentally changed. Now, let's switch gears and talk about how the company is actually making money or not making money. Here are their statements of earnings for the 3 months ending June 27, 2025. Ralliant reported sales of $503.3 million. This is down from $533.7 million in the same period last year. That's a decrease of about 5.7%. And when we look at the operating profit, that also took a hit. For the 3 months ended June 27, 2025, it was $58.9 million. Compare this to $105.2 million in the same quarter last year. And, well, that's a drop of almost 44%. The operating profit margin also significantly declined. It fell from 19.7% in the prior year's comparable quarter to just 11.7% this quarter. This is a pretty substantial margin compression and something investors will be watching very closely. Drilling down into their segments, the test and measurement division looks like it's going through a tough time. Sales here dropped by nearly 15% year over year. And this segment actually posted an operating loss of $14.3 million for the quarter. Last year, it had an operating profit of $24.6 million. This is a dramatic swing from profitability to a loss. Their operating loss margin here was negative 7.4%. That's a huge problem when you consider it was a positive 10.9% just a year ago. The report mentions demand weakness across all their end markets for this segment. Meanwhile, the sensors and safety systems segment is showing more resilience. Sales here actually increased slightly by about 1.1% year over year, and their operating profit margin for this segment remains strong at 25.6%. Though it's a slight dip from 26.2% in the same period last year. Now let's talk about what happens when a company separates. Ralliant has established its own stock incentive plan, the Ralliant Corporation 2025 Stock Incentive Plan. This is standard practice after a spin-off, as the new company creates its own equity-based compensation for employees. The company also recorded a loss from divestiture of $25.6 million in the prior year. This was related to the Invatech business, which was divested. This loss is not present in the current year's results. There's also a tax matters agreement with Fortive. Ralliant expects to pay about $50 million for certain tax transaction costs related to the separation. This is a pretty common post-divestiture settlement. Speaking of leadership, Neil P. Reynolds is listed as Chief Financial Officer. He signed off on this report, so clearly he's a key player in managing the company's finances. So what's the story here? Ralliant has just gone through a major separation and financed its operations with a significant amount of new debt. Their test and measurement segment is struggling with declining sales and profits, even posting a loss this quarter. This is a big red flag. The sensors and safety systems segment is performing better, but not without its own slight headwinds. The huge increase in debt is definitely a major point of attention. They've gone from virtually no long-term debt to over $1 billion in debt almost overnight. This will add significant interest expenses going forward and puts pressure on their ability to expand or weather any future downturns. Overall, Ralliant is in a transitional phase. The success of this spin-off and its future growth will hinge on its ability to turn around its struggling test and measurement segment and manage its newly acquired debt load effectively. The contrast between the two segments is stark, and the company needs to address the weakness in test and measurement quickly. Alright, that's our breakdown of Ralliant's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord community linked in the description for more insights and to chat with fellow finance enthusiasts. Thanks for watching, and we'll see you next time on Corporate Decoder.